You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, last week we went to a strategy that I've talked about quite a bit on Options Playbook Radio and through my years, in that it's a rinse and repeat strategy. In the S&P 500 index, there are a couple of things that I like to do when conditions get right to do them in the S&P 500 index. And that index is a very interesting index in that it has a lot of expirations. It's a fairly liquid index, even though it's not 100% transparent exactly where the markets are at. You just got to kind of find them, but you usually do get pretty good fills in it. And it's a 4,000 point index. So you have very expensive option contracts. And when you have very expensive option contracts, that always changes everything up, in that your short-term weekly options are very interesting from a pricing perspective to put interesting trades together. And I've looked at skip strike butterflies, obviously the good old iron condor. But one of the things that I like to do in the SPX is try to sell the at-the-money option contract and all that juice in the short term. So last week we did this trade once again, and we always have a hedge with our trade. And we talked a little bit about it last week, but this week we really don't need to get into the hedge. And part of the reason why is that the trade actually worked out. And sometimes on Options Playbook Radio, when we do get the direction right, it's not as interesting because we can't talk about an alternative trade, or it isn't quite as apparent as to what we would have done if the market went against us. Okay, so we did a short-term expiration. We taped Options Playbook Radio last week. The markets were open. It was Thursday, June 3rd, and we ended up with the market, the S&P 500 index at 4,185. We ended up selling that 4,185 strike call and then going 5 points in the money and buying the 4,180 strike call. And the market has actually gone up. It hasn't done much but gone up since that day. Now, the market kind of opened up the next day. You could have potentially even got out. Right now, the market is at 4,230. This trade is in the money. At expiration, one of the great things about the S&P 500 index is you don't necessarily even have to do anything. You can try to trade out of it, but as long as it's above that our sold strike price of 4,185 is a cash settled index. So all that happens is the cash goes from someone's account into your account on that expiration date. There's no buying and selling of the actual stock. So that's one of the benefits of trading in the S&P 500 index. And that's a fairly big benefit relative to trading something like the SPY, which is a ETF, is the ETF that basically tracks the S&P 500 index. It's one of the most popular ETFs out there and liquid. And in that instance, when you're trading an ETF, you're actually buying and selling the stock. There is a dividend that's paid on it, and there's different tax ramifications. So there's just a lot to think about when you're doing these type of strategies. But one of the biggest things I like about the S&P 500 index is the amount of juice, and that you have many different expirations that you can choose from. You can really craft your strategy. But we put this together on a Thursday with a Friday expiration. If I do have increased volatility, and right now we see the VIX index trading at 17, and that VIX still being up around the 20 level, makes this trade interesting to sell that at the money vol the way that we talked about it. And it also allows you to then adjust the trade. One of the reasons why you can adjust trades is that you need some premium left in the option contract to make an alternative trade interesting. And if you did it on a Thursday going all the way till Friday, 1 day's worth of time premium in the S&P 500 index is a lot. So if it does go against you, what we were looking to do is to actually roll into a butterfly. That old adage, I don't want the cheese anymore, just let me out of the trap. So if the market had, instead of the next day going up 20 points, it actually went down 20 points, well, then we're just going to roll into a butterfly, take a little bit of risk off the table, still have our chips in, right? Still have a chip in a chair, and hope that the underlying stock at least comes back towards our short strike of our butterfly at that point in time. All right, so that trade worked out fairly simple. And now we're past earnings season. Well, not 100% past, but there's still a few earnings reports that are trickling in. But with that said, a lot of the major companies have announced earnings. Earnings were really good relative to last year and the year before that, and that they were very strong, but we didn't get a lot of movement in the stock. We're finally seeing some momentum to the upside in a lot of the indexes overall. So I'm going to talk about a fear of missing out. A lot of people are talking about meme stocks, and they're talking about the tech stocks. Apple just had a big meeting this week, big powwow, I guess, for lack of a better term, with all of their programmers, and talked a lot about some of the new features that they have on their new operating system. So there's been a lot of news in that direction with the techs and the meme stocks. And we're going to look at this little known industry called the energy industry. And the stocks are making a move. Oil's making a move. So I think it's time to do a FOMO trade, a fear of missing out. And the underlying stock we're going to pick today is ExxonMobil. They've had some news recently, too. Stock is up today, and I should let you know that we are taping Options Playbook Radio. The market is open today. Usually we tape after the close, but today we're taping with the market open. It is Wednesday, June 9th. ExxonMobil is trading at $62.85. It's up 72 cents. So how can we manage our risk and do a FOMO trade in the energy stocks? Now, a lot of people will just say, well, why don't we trade the XLE, trade some ETF that tracks the energy industry. And I don't mind that. I don't mind the way to approach that. But one of the things about some of these energy ETFs is they have fairly high fees in them. And they just don't seem to move as much as the underlying stocks do, just in general. And that's what they're meant to be, right? ETFs and mutual funds in general are meant to try to mute some volatility, but still give you some upside and take away a little bit of the risk to the downside and give you some of that upside exposure, but without all the volatility. So I'm going to minimize that risk by investing in a particular company. And you can pick whichever one you like in the space, but volatilities have came in. We mentioned that in the VIX. It's really came in on a few of the stocks. And we've done some strategies because volatility has came down a little bit. It's still elevated, but it's came down a little bit. And I like going out further in time in this space on the underlying stock that you want to trade and buying an in-the-money option contract as a substitute for owning the stock. You're managing your risk that way. And these options on ExxonMobil in general, being a $62 stock, not extremely expensive. And we're going to go all the way out to that January expiration. That January expiration is 226 days away. We're going to go down and buy an 80 delta option contract that's going to give us some exposure. And the 55 strike call on the January expiration, which is 226 days away, is trading at $9.20 by $9.35. And that's always the issue with buying longer term leap options as a substitute for the underlying stock is the width, the bid and ask of the markets. A lot of times you get $1, $2, $3 wide bid ask spreads. But in our situation here, it's fairly tight for a leap option contract. We have open interest of around 25,000 contracts. Volume today, the market has just opened, but the volume is at 32 contracts in general. So there are certain stocks where doing a long-term leap option as a substitute for the underlying is a feasible strategy to do. And even if I get a little deeper in the money, the markets are still fairly tight in ExxonMobil. Now, there is some news coming out. Oil inventories are coming out today. I don't know exactly when. Maybe they already have. But with that said, I just think that this is the one industry that has been clawing back. It's been doing well recently, but it's still not back to its pre-pandemic highs. And so why not? If you're thinking about doing it, let's manage some of our risk and use a long-term, deep in the money, 80 delta leap option as a way to play in the space. So as opposed to buying 100 shares, if you were thinking about buying 100 shares, we're just going to buy one leap option. And if you're going to buy 200 shares, well, then you buy two leap options. It's that simple. You don't want to increase your leverage. So we need to think about, well, how many shares would you normally buy with the monies in your account? And so as opposed to just saying, well, I'm going to get more leverage and I'm only going to pay $9, let's call it $9.30 for this option contract, as opposed to paying $62,660 for 100 shares of the underlying stock. Well, I can buy a lot of these. And so I'm going to buy as many as I possibly can with those funds. No, that's not the concept here. The concept here is that I want to limit my risk. And if I buy this leap option as opposed to buying the underlying stock outright, I'm going to limit my risk, and my maximum risk here is going to be 14%. If all the premium came out and I lost that $9.30, which is the maximum I could lose. But I do have a lot of upsides. So for every point that it goes up, this option contract should go up about 80 cents. I'm getting that type of exposure. Now, I'm going to let you know one of the things about owning the stock, though, that's good about ExxonMobil is that it has a 5.6% annual dividend rate. So it does pay a strong dividend. And if you own the stock, you have rights to the dividend. But I want to let you know that you kind of get the dividend when you're buying leap options also, because if the stock does pay a big dividend, the call prices will be cheaper relative to the put prices on that same strike line, on that same 55 strike line. So the dividend is figured in to the pricing of the leap options. And if the dividend goes up, calls will go down and puts will go up. And that makes sense because the more of a dividend that it pays, when it pays that dividend, the underlying stock is going to go down by that amount. And if it goes down, it helps puts and it hurts calls. So guess what? The market has smart enough to figure that out and actually prices that in your call options, meaning that you have a lower overall risk to start with because you're getting that discount when you're buying those leap option contracts. All right. So with that said, it's a very simple, straightforward plan. If we buy the 55 strike call, and as I mentioned, $9.30 is about 15% of the underlying stock price. You might say, Brian, well, that's still a lot. I don't want to lose 15%. And I agree with you. That would be a lot. But one of the things that I always approach when I buy these leaps or these FOMO strikes is that I got to have a plan. And just like how we like to sell the at-the-money option contract in the S&P 500 index, we're going to actually take that same approach about it being at the money and getting some of that juice. So with the underlying stock right now, just about at 62.66, that's where it's at currently. If the market did come down to my short or to my long strike, to my 55 strike, I'm just going to sell it and get out. So if I get that move to the downside, what's wonderful about these leap options is that on the upside, the delta will gain, it will increase. So right now, stock's at 62.66. If it goes to 63.66, 64, we pick up delta. On the way down, it slows down. The acceleration gets lower. And an at-the-money option contract would normally have a delta fairly close to 50. So we gain shares on the way up, or delta, and we gain acceleration on the way up. And on the way down, it slows down. So if it goes down to the 55 strike, my plan would be just quite simple. I would just sell it. I would sell it and get out and capture the at-the-money time premium, which is going to slow down the acceleration as the underlying stock goes down overall. All right, so let's summarize this. We're going to do a fear of missing out trade here in an energy stock. We just happened to pick ExxonMobil. As always, this is not meant to be a recommendation. We're just trying to learn here. Part of the reason why we're going to do this is that the energy space is in the news a little bit this week, and it's finally making a little bit of a move to the upside. How can we participate without all the risk of actually buying the underlying stock outright? Volatilities have came down, so we're going to go all the way out to that January expiration, 226 days out. And we're going to go a little deep in the money, buy that 55 strike call. We're going to pick a little bit in the midpoint, just maybe give up a nickel or two from the a nickel or so from the midpoint. So we're going to pay $9.35. Our maximum risk on that trade then becomes $935 plus commissions to do that trade. It's always worth noting that ExxonMobil does pay a very big dividend, about 5.6% annually. And because of that, we're going to get a little bit of a discount when we go out and buy our option contract overall. So our max risk will then be that $9.35 or $9.30, $930 plus commission, and we still get all the upside. And notably, that option contract that we're looking at buying is trading at about a 24% implied volatility, which has came down precipitously over the last couple of months. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
You're listening
listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.